Is New York Community Bank about to get bailed? NYCB flagged internal issues that sent the bank tumbling 20% after hours, and we need to discuss what this means for markets. Are we starting to see the early signs of SVB 2.0? We also need to talk about key levels in the S&P 500, PCE data, and why this stat tells us exactly what will happen next. So let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video. Let's get into it. Pretty green day in the market, especially when you have all of the mega caps perform the way they did. I mean, Apple didn't quite get there and Tesla was flat, but other than that, we had like complete outperformance in semiconductors, tech as a whole, software. The bigger names in financials did perform. Regionals green right here, but they're going to be red tomorrow. I'll tell you why a little later. And then we had healthcare. They were the only red sector along with consumer defensives. Something going on with those two. Monster Energy put up a 5% day after Celsius Holdings put up a 20% day on their earnings. All in all, sectors were either flat on the day or they were really outperformed. The worst performing sector was healthcare and staples. Other than that, it was a pretty positive day. I mean, we just had like energy and utilities below the SPY. Every other sector performed better than the SPY as a whole. Look at industrials, materials, discretionary, software. The best performing sector was GDX. It felt more like a short squeeze today. A lot of people who were short just taking a lot of profits off the table. A lot of people are expecting gold to bounce back. So if we do see outperformance in GDX over the next week, I actually would not be surprised, despite what the inflation numbers came in as. Semiconductors, the best performing sector here. Technology up there too. Regional banks, guys, New York Community Bank was down 20% after hours. I just read a headline. I think it was like there was some internal weakness they didn't measure or didn't foresee, something like that. So I think regionals are going to get absolutely hammered tomorrow, and that actually might spell some more bank trouble ahead. Let me actually pull up a chart. So down 21.63% in after hours. This is all after hour trade, this gray box right here. And yeah, well, peak to trot down 21%, probably down like 15% right now, but pretty crazy trade when you think about it. And this could signal some more bank troubles ahead in the future. All right, guys, so let's have a look at the market as a whole. The S&P 500 up 0.5%, the Nasdaq nearly 1%. Same with mid caps. We had the S&P 600 up 0.64%, the RTY very similar, but both of these indices, S&P 600 RTY, were up about 1.5% in very early trade. They did par a lot of the gains they made, but still very positive on the day nonetheless. Not much happening after hours. We can also see the RSP up 0.41%. So very positive day across the board. Bitcoin up 3.1%, and not much else happened in gold, the dollar, or crude for the most part. But looking at the S&P 500 more closely, we actually see constructively bullish price action here, guys. Now, very, very interesting day of trade, extremely interesting day of trade. So we still have this huge gap right here, and we were expecting a couple of things to happen if PCE was to come in hot. We said if PCE came in hot and we gapped down, stayed above this level right here, 49.45, that would be bullish and we can actually buy dips looking at higher price action. If we actually gapped below this 49.45 area and went anything lower than this candle wick right here, 49.20, that would be a bearish scenario, and then we can actually look for lower price action. That didn't happen, and this right here we would consider no man's land. However, what happened was PCE came in line despite all of the indecision we had all week, and we actually rallied quite significantly. Now, we actually did gap up all the way to here. Sellers did do a really good job at taking us lower, but we couldn't break the day's low. You could actually say it was an equal low, a slightly higher low, equal low, but then buyers came in a very big way and didn't just take us to the open, took us well above Monday's high, this right here, but then sellers did bring us back to reality, and we closed in line with Monday's high and above Monday's close, which is very, very constructive. Now, if the S&P 500 tomorrow was to continue this bullish action and we were actually to go break above this high, let's say close the weekly at a new all-time high, that's insanely bullish, and then this would just be another higher low. And then we actually zoom out right here and then we look at it, right? We've actually formed like a low, higher low, higher low, higher low, higher low, higher low, higher low, all the way up. We then go make an all-time high. That's insanely bullish. And if we actually have a look at the S&P 500 on a monthly chart, this is insanely bullish. We barely got a wick at the top, and on a monthly chart, there's just no way you can look at the market right now and call for any type of impending doom. And even on the monthly chart, we can afford a pullback all the way to as far as 45.92. Let's just call it 4600 flat. We can afford a pullback all the way to 4600, and we would still be constructively bullish on the monthly chart. In fact, in my personal opinion, we would be constructively bullish all the way to 41.93 here in the S&P 500, and this is October's lows. But I'm going to do a full breakdown of the monthly chart and the weekly charts in the weekend video, so go ahead, subscribe to me so you don't miss those. But going back to the daily chart, we can actually see that this is very bullish price action. We go ahead, make another all-time high tomorrow. That's going to be super bullish. Now, I do think a lot of the selling we saw at the end of the day in the SPY had to do with what we saw with regional banks. Sometimes people just get nervous, want to take risk off. There's no harm in that, especially when you get news like we saw in regionals today. And I do think we're really going to feel that tomorrow in the financial sector. But all in all, guys, this looks very, very bullish. The exact same thing with the Nasdaq. We were saying the Nasdaq was looking very exhausted, but let's say this is the low and we go and make a higher high. Again, that's super bullish because we couldn't even break this wick low from last week, this week, and we go and put a higher high. That is still super bullish. And you know what's crazy about the Nasdaq? Apple is barely participating in this move. Same with Google, and we're still putting out higher highs in this index. So that's actually very, very bullish. Overall, indices are looking bullish after that PCE print. And if we go rally, make all-time highs tomorrow, that is just going to further cement March as possibly a very, very bullish month. Now, the reason why we had such a positive day in the market had to do with PCE. Guys, PCE came in completely in line. Now, headline PCE is actually still above the Fed's 2% target, but the Fed only do expect to get there around the middle of this year. Headline PCE is currently at 2.4% on a year-over-year basis. Then we also had core PCE, which is at 2.8% on a year-over-year basis, and that came in at 0.4%. It came in line with Wall Street's estimates, still above Wall Street's targets on a year-over-year basis. But if we actually have a look at it on an annualized basis, you can see a 1 month annualized, 3 month, 6 month annualized, and on a 3 month annualized basis, we are actually below the Fed's 2% target, as you can see right here. And on a 6 month annualized basis, just above it, I believe at 2.2%. So on some measures, we are still within the Fed's PCE target of 2%. And this is really why the market rallied. You know, they looked at the data, it came in line, and that's exactly what the market wanted to see. I think with the way the market was moving over the last 4 days, they just didn't quite know what was going to happen. There was a lot of uncertainty, and then when it comes in line, that's actually bullish when we have a lot of uncertainty. Now let's talk earnings, guys. So we're going to talk about Celsius Holdings right here, simply because this was actually one of my top pick stocks for the year, and they absolutely smashed earnings. Financial year 2023 versus 2022, 102% change in revenue. Gross margins went from 44.1% to 48%. This is where it gets crazy. Net income went from a negative in financial year 2022 to a positive to $182 million, I believe. Then we had diluted earnings per share. We had a negative earnings per share in 2022. Now it's positive. And then adjusted EBITDA came in at $295 million. A very, very good quarter. Quarter over quarter, a 95% increase in revenue. Absolutely insane stats, guys. And this is what the stock looked like, up 20%. By the way, pre-market it was down 6%, and that was a great buying opportunity because it would have been up like 26% on the day, and it's probably going to go to the 90 level, I reckon. And this is when exactly I told you guys to buy it. I said on the 12th of March I'm long CLH at 120x. I put up this meme right here. I was kind of a little bit joking there with the meme, but yeah, up 20%. Probably going to keep holding this. This is probably going to go to $90, I would say, before we see any weakness. Probably going to rally again tomorrow and most of next week. I do believe we might have a bit of a pullback, but I do think the path is higher. Now we got the latest AA sentiment survey, and this is very interesting. More people turned bullish, less people went bearish, and a lot of people that were in this bear camp last week capitulated to the neutral zone and capitulated here to the bearish zone. Maybe they're finally going long. At the same time, what we are seeing is a sustained trend above the 40% mark here in bullish sentiment votes, as well as from 4 weeks ago, actually falling in the bearish sentiment votes, and then the neutral staying about the same. And this is the thing, guys. A lot of the time when you get the whole market bullish, it isn't necessarily a contrarian signal right away, because in a bullish environment, we can go on extended rallies for insane periods of time. I mean, the 1 year bullish high, this was on the 20th of December at 52.9, right? Sure, it is down since then, but we've been above the 40% mark since the last week in December. Today in Australia, it is the 1st of March. So it's been about 2 months, 3 weeks that we've been in this insanely bullish price action. And trust me when I say this bullish price action, this bullish momentum can continue. When the market goes on bull runs, it goes on runs for an extended period of time, much longer than you would think. Now, the S&P 500 has reached 12% above its 200-day moving average, quite historic, and these are the returns we can expect. So we do have just about 30 data points. If you talk to any statistician, they'll say you need about 30 for there to be any statistical significance in the data. Now, we could see a 2 week, 1 month, 3 month, 6 month, 1 year out. What can we expect? You could see average return 13.8%. We do get a bit of sell side a bit early on here at the start, 2 weeks out, we can have a bit of a pullback, but momentum brings momentum. And you could see even 1 month, 3 month, 6 months out, we do get fairly average returns in the index, despite having already rallied significantly to be 12% above the 200-day moving average. And you could see 6 month, 1 year out, 93% positive. Very, very positive stats. Now, a big driver of growth has to be the cost of capital and how much can companies acquire capital for. And the way we normally measure this in the S&P 500 or stock markets as a whole is through something called a weighted average cost of capital. And it's essentially what companies are financing their debt at. As interest rates have come down in the last 10 to 20 years, so too has the cost of capital. And we did see this spike up right here in 2020 after the COVID situation. Now, the 2020 forecast is for pretty much the cost of capital to be where it is right now, call it 5%. And excluding this recessionary period here in 2008, the cost of capital is actually some of the highest it's been in the last 10 or so years. But with it coming ever so slightly down, we could see here that it does actually favor asset heavy stocks. So we could see here that when the weighted cost of capital goes down, it's inverted right here. Asset heavy stocks do actually follow that trend, and they do actually perform very well. So asset heavy stocks would be stuff like industrials, manufacturing, healthcare stocks. Asset light stocks would be stuff like Google, Meta, stuff like that, more like software application type of stock. So if the cost of capital is going to fall, it's going to benefit these stocks, asset heavy stocks as a whole. These may present a good discount because we're going to talk about valuation a bit in this video. And you could see here that asset heavy versus asset light median next 12-month PE. And you could see that asset heavy trades at a deep discount to asset light stocks. And that's because we've had a massive tech driven rally, a software driven rally. And right now the discount is at about 20% relative to asset light stocks. This is the asset heavy versus asset light index performance. And very similar to this chart right here, asset heavy has completely underperformed the asset light sector. And maybe this is about to tick up, especially if the cost of capital and rates do go down in 2024. Now, here's another interesting stat when it comes to asset light versus asset heavy sectors. The percentage of S&P 500 market cap by sector 1980 to present. Manufacturing was the dominant class in 1980. 66% of the S&P 500 was in manufacturing. It's now just 18%, with innovation, let's call it technology, software, hardware, semiconductors, now making up half of the index in 2024. One thing we can also see is that financials and real estate investment trusts have actually increased all the way to about 2004. And I think after the 2008 situation, the great financial crisis, we have seen this decrease, still about 16% of the S&P 500. Then we do have consumer stocks like discretionary staples making up the remaining 17% of the market right here. Very, very interesting stuff to see the composition change in the world from about the 1980s all the way to 2024. And do expect this trend to continue. The only thing that's consistent in the world, guys, is change. It's the only constant. Now, guys, looking at valuation, this is the equity risk premium for the S&P 500, Mag 7, and the other 493. Now, the historical average is 590 basis points. And essentially, this is the excess return you'll get from holding equities versus like a 10-year bond. And essentially you take this number, so 5.9%, right, plus what you're getting on a 10-year, let's just say 4% for time's sake, and then you should get a return on average 9.9%, and that is the average return of the S&P 500. Now, the current ERP, the current equity risk premium for the market is at about 2.5%, so that's what you would get on top of the bond for holding equities, at least on average. Is it a sure thing? Not exactly, because had you held bonds, in 1982, 83, 84, you'd have missed out on a probably 400% rally all the way to 1999, but eventually the market does revert back to its mean. At the same time, according to BofA, price to normalized EPS suggests 3% returns over the next 10 years. So you can see that over the next 10 years, we're going to get to a point where valuations are so high that we're only going to be expecting 3% annualized returns. It just means the market is going to revert to its mean. But for the most part, in the here and now, we can expect 7, 8, maybe 9% annualized returns here in the S&P 500. And to be honest, that's really all you can expect in an index. If you want outsized returns, you may have to go individual stock picking. That being said, based on current valuations, forward returns don't look that great. That being said, global growth is firming up. We can actually see here that bullish and neutral signals in the global growth economy is actually moving up. We're now at 71% from the previous 43% we saw in March 2023. And essentially, global growth indicators troughed out right here. We're moving higher, and hopefully we can get back to these highs we saw here in 2019, 2020, around this level right here. Maybe some of the highs in 2021. That would be very, very good. That being said, the global economy is doing really, really well, at least according to this data. Looking at CEO business confidence, CFO business confidence, we can actually see that we are ticking up in these indexes, and that's a really, really good sign. CEOs know what's happening in their business. They sort of have really good projections of what's to come, and the fact that they're getting more optimistic on the US economy is a really good sign that, number one, the economy is doing really well, we're in a good recovery, and that we are expected to have a stronger economy, and that means higher equity prices. At the same time, we're also seeing that we are in an earnings-driven year, guys. Last year was a multiple expansion year. This year is an earnings-driven year. The global earnings profile is evolving towards a promising high single-digit growth outlook for the year, with the risks skewed to the upside, so hold equities. Leading indicators aggregate anticipated high single-digit growth in the global earnings in the next 12 months. Global EPS growth projection based on Asian export growth, global manufacturing PMI, global manufacturing new orders, global earnings revision ratio, corporate guidance for the US, and the BofA China financial conditions indicator. We are expecting growth in the low single digits right here. Now, could this continue upward like it has in the past? It most definitely can. But as it stands right now, guys, 8%, 9% growth is actually very, very healthy growth considering where the economy was just a year ago with all the tightening that had to happen with central banks to control inflation. Now, another stat that's going to support the likelihood of a recession is actually this stat from Fred and Unlimited calculations. Now, this is so very interesting. This is the likelihood of a recession in each 6-month period post an inversion. Now, we do know that the yield curve is a very reliable indicator of an incoming recession. As you can see right here, every time the yield curve has inverted, a recession, this gray box, has come as a result. It's not when the yield curve inverts, it's actually when the yield curve uninverts, then we normally get a recession. You can see here, inverts, uninverts, recession, inverts, uninverts, recession. And this is where we are right now. The yield curve is deeply inverted. What we are waiting for is that uninversion in the 10 to 2 year, and then the recession should come as a result. However, we might not get a recession simply because, according to these stats right here, this is the likelihood of a recession in each 6-month period post inversion. Now, the yield curve has been inverted for about 500 days. That's about 17 months. So we're in this period right here. So we're at the end of this 13 to 18 month period. And long story short, there is a 61% chance of the economy falling into a recession. However, in just a couple of months, in about 30 to 60 days, chances of a recession, despite the yield curve inverted, falls to 14%. And actually, the historical average is about a 15% of the time we can actually expect a recession. This might actually be the second ever yield curve inversion where we don't get a recession. We actually did have one before in 1966. And if we don't get a recession in the next 30 to 60 days, and the chances of that are highly unlikely, we can say without a doubt that this time is is different. Now, something else to note here, guys, I got some very interesting data, and this is cuts and the expected future returns in the S&P 500 when cuts were done to normalize policy, if they were done out of panic, or if they were cut in light of a recession. Now, because it's very likely we are going to avoid a recession, the Fed will likely cut rates to normalize policy. By cutting rates to normalize policy, what returns can we expect in the S&P 500? 12 months later, 100% win rate, by the way, 13.2%, median return 11.5%, absolutely incredible. So near-term volatility, long-term gains, and we can actually see here also if cuts are done out of panic, 17.4% average return 12 months later. The only time we get negative returns 12 months later is if cuts are done because of a recession, and we do know that's not likely the case, especially if we do go in the next 30 to 60 days and the economic data continues. And this is actually what it looks like in chart form. When the Fed does cut rates because of a recession, we normally get very steep drawdowns in the S&P 500, very close to 20% 12 months later. If it's to normalize policy, we actually do see quite stellar returns, particularly in the first 6 months, and then a bit of volatility from about 6 to 10 months, and then a steep rally into the last 12 months, and totaling anywhere from 10 to 15% 12 months later. Now, guys, looking at gamma, very interesting developments. The gamma flip zone continues to be at 5,000, 5,100, the core gamma resistance, and we haven't seen this move up yet, and that's a very big tell into the sentiment in the market right now. Investors and traders are being very cautious. We've also seen quite a lot of negative gamma coming to the tape, and you could say that this is investors hedging some downside risk just because the market is looking a bit exhausted, looking a bit skittish at the top, and a lot of the positive catalysts are behind us. That being said, we are still in positive gamma, so buy dips, sell rips until we either get below the gamma flip zone or we see a lot more negative gamma come into the tape. That is my advice for you now. This is the tactical approach we use on this channel, and we will continue to use it. So for the moment, buy dips, sell rips until we really break some of these key levels and see major moves in the tape. Now let's have a look at some very interesting charts I have for you guys. This is what a correction in time looks like. This is what a correction in price looks like. You can see that the market correction in the equal weight was characterized by time rather than price, and we are just about 1.3% away from breaking all-time highs here in the equal weight, and this is bullish. Now looking at the core leadership model right here, we're back into strong leadership, and here's the thing, on a week-to-week, month-to-month basis, the S&P 500 is looking very, very strong, and no bearish narrative can change my mind, only data can. And when we break below zero, that's when I can get a little bit bearish, but until now we have to look at the data, and all dips should just be looked as opportunities for higher price action in the future. Looking at the Fed Financial Stress Index, do note it is inverted, guys, and essentially what this measures is the degree of financial stress in the market, and we are below zero. We have been for 47 weeks, and there's not really a lot of financial stress in the market. And again, only the data can change my mind. Until we get below this mark right here into this red territory, that's when we could start looking at really hedging for some serious downside. Until that happens, until we see maybe a commercial real estate bust, a regional bank run, there's nothing to be worried about in the market right now. Looking at the S&P 500, guys, out of the 11 sectors in the S&P 500, 10 of them are above their 50-day moving average. Very, very bullish. This is the S&P 500 percentage of stocks making 52-week highs. 35% of S&P 500 stocks are making new 52-week highs in the past 2 weeks. This is the highest level in 2 years. Very bullish. Again, only the data can change my mind, and very likely we can pull back 100%, but this will probably go higher as the rally broadens out, and as it has broadened out. Looking at some key risk ratios, they continue to grind higher. High beta versus low volatility, that's risk on. High yield bonds versus treasury bonds, that's risk on. Consumer discretionary versus consumer staples, risk on. And again, only the data can change my mind. And last but not least, 2024 has not seen a risk off signal yet. This is risk on, this is risk off. We're still deep in this risk on territory. Can get a bit dicey when we get below these levels, especially if it is extended, but as it is right now, it looks like the risk on sentiment is going to continue. And normally when we do get risk on, we can actually go on these long extended rallies, and that's when we get like these runs right here, these runs from 2016 to 2018, and hopefully we go on a much bigger run for the rest of the year despite where valuations are at, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys, like this video, and leave a comment. Cheers.